Good morning and welcome to this Money Control live stream. You're watching Opening Bell with me, Nandita Khemka. Well, midweek blues across global markets. We've seen the US markets tumbling overnight once again, on concerns of lofty AI valuations. Mind you, today Nvidia will be reporting numbers, in after hours in the US market, and of course we will be reacting to it tomorrow. But yes, lots riding on that, given the fact that we will be watching out for what the Nvidia CEO also says about that $500 billion order book that was being talked about. Whether he gives us some color as to how things will pan out on that front. That's something that the street will be watching out for. And if the earnings are above expectations, or if it manages to beat expectations, that perhaps would allay some concerns that are there with respect to AI valuations. But yes, that's the important cue to watch out for from the global markets. But otherwise, the texture is fairly gloomy to mixed, because Asian markets are kind of, cutting through the gloom. In fact, the Nikkei, last time I checked, had edged back into the green. That comes after a 3.5% cut in trade yesterday. So some bit of stabilization across Asian indices at least. But US markets, things weren't all that pretty. But barring the technology names, rest of the markets did fairly okay in the US markets as well. So it's the tech heavy pack that's really weighing in. And of course, if Nvidia numbers are much better than what the expectations are, then perhaps we could see some bit of stabilization there as well. GIFT Nifty this morning giving mildly higher signals. So let's see, we may look at some green on screen at the open. And of course, lots of stocks in focus, the likes of HUL, Infosys. Some color on the demerger with respect to HUL and with respect to Infosys. The buyback will open later this month. In fact, on the 20th, that's when the buyback opens. So yes, lots to digest. All your stock related queries will be in focus. Keep them coming in. We'll try and get them addressed on the show as well. But before we move on to all that, let's take a quick look at what the headlines are at this hour. Wall Street sell-off continues as tech sell-off deepens ahead of Nvidia's earnings. Dow closes down nearly 500 points, while the S&P 500 logs its longest slide since August. Asian markets mirror moves on Wall Street, although there are signs of stabilization, with the Nikkei inching back in the green after yesterday's sharp fall. The GIFT Nifty indicating a mildly higher start for our markets. Crude prices edge up as traders assess the impact of sanctions on Russia. Meanwhile, gold gains on soft economic data. Traders are also weighing the chances of a US rate cut later in December. Meanwhile, Bitcoin dips briefly below that $90,000 mark. Among stocks to watch out for, HUL sets December 5th as the record date for determining eligible shareholders who will receive shares of Quality Walls in a 1:1 ratio. The ice cream business demerger becomes effective on the 1st of December. And Infosys will open its 18,000 crore rupee share buyback on the 20th of November, offering to repurchase up to 10 crore shares at 1,800 rupees each via the tender route. The buyback will close on the 26th of November. All right, yesterday was a volatile day, but we did end near the low point of the day, took out 25,900 on the downside. In fact, the market also snapped out of a 6-day gaining streak. We failed to hold on to the 26,000 mark, which we reclaimed on Monday. And of course, a lot of that has to be blamed on the global cues, because the European markets were also falling. At open, we saw sharp cuts across Asia, and of course, Wall Street has already been under the cloud of concerns over AI valuations. So global cues weren't supportive. We did make an intraday recovery at one point in time. We were much above that 25,900 mark, and it looked like we could perhaps edge back into the green, but that really didn't happen, because in the last hour of trade, we once again succumbed and in fact ended at the day's low. The market breadth was fairly weak yesterday, 2:5. That was the NSE advanced decline ratio. The mid cap index, which hit a record high earlier in the week, underperformed. In fact, even on the Nifty, more than 40 stocks ended in the red amid all-round weakness. Realty and metals, these were the top losing indices. But there were some gainers in the form of Bharti Airtel that gained somewhere around 2% or so on the back of a rating upgrade by S&P. In fact, the showstoppers yesterday in a weak market were the likes of Grow and Physics Wala, the recent listings. In fact, Physics Wala listed at a premium of 33%, but ended the day higher by 44% or thereabouts. And Grow, of course, we all know it is almost 90% up from its IPO price, market cap well above that 1.1 lakh crore mark. So yes, in a weak market, we had these new or recent debutants doing extremely well. In terms of the fund flows, of course, FIIs were net buyers in Friday's session, and one would have hoped that the buying would continue, but that didn't really happen because FIIs were among net sellers yesterday. They sold shares worth 720 crore rupees or thereabouts. DIIs, however, continue to buy, and they bought shares worth 6,100 crore rupees in the cash market. Put call ratio fell to 1.02 versus 1.13 in the previous session. But on that note, to understand the texture of the market, let's bring on board Ajit Mishra, Senior VP Research at Religare Broking. Ajit, lovely chatting with you. What is the setup really looking like for you? GIFT Nifty hinting at a mildly higher start yesterday. We did, make an intraday recovery, but completely fizzled out. What do you sense? Do you see some strength, or would you say that it could in fact edge towards 25,700? That happens to be the next support.
Yeah, good morning, Nandita. So, Nandita, just see the broader picture. Means what we are observing that it's been almost like, we are in the 5th week of consolidation largely. Means earlier we were seeing more of time-wise correction to start with. Then there was marginal dip. Last week, it turned out to be a recovery. But we've still not surpassed the October month high, which is placed around 26,100 mark. So it seems like that after the October rally, market is taking its own time to surpass this level, because we are just like, whiskers away from the record highs levels, which is around 26,277. So I feel it's a healthy consolidation as long as, like you rightly mentioned, 25,700, the 20 days of exponential moving average. Until we decisively break that mark, this consolidation should be seen as a positive sign. Because if you talk about the key sector, banking specifically, which is making record highs with every passing day, rotational basis, we are seeing heavyweights from across sectors also participating in the move. So barring small cap, wherein we are not seeing any strength, decisiveness, rest of the pack, they are contributing, they are helping the market to maintain the positive tone. So yes, indications are in the favor that the consolidation might continue in the index, but 25,700, as long as we are maintaining this mark, one should continue with buy on dips approach. The moment we'll cross 26,100 levels decisively, we are set for the next leg of the up move. So maybe it could be some fresh trigger because earnings are behind us now. So any positive clues, because mentioned about Nvidia's results scheduled tonight. So that might subside at least some volatility in the US market, which is currently experiencing, and help the markets to regain the composure and inch toward the higher levels. So as of now, stock specific approach is something that you should continue with 25,700 being the key support.
Okay, 25,700 key support, and unless 26,100 gets taken out decisively on the upside, you could still see some bit of weakness or volatility on the charts. But what about the Nifty Bank Index? We conquered that 59,000 mark earlier this week. In fact, we hit record highs. Yesterday, I think the Nifty Bank Index managed to outperform. What are your thoughts there? Which are the stocks that you're liking on the Nifty Bank Index?
Right. So it's like a lone warrior, which is currently holding the front, because IT after the initial surge, we are seeing a bit of profit taking here also. But the texture looks positive in banking, despite the yesterday's profit taking at higher levels. And we believe that 59,200, 500 is the area basically where we have the next target zone. In case if there'll be any profit taking around 58,500, 58,200 zone, one should consider as a buying opportunity. PSU banks outrightly they are leading from the front. No doubt, selectively from the private banking space also we are seeing strong traction. The stock like Axis, wherein we have seen a fresh breakout. Then we have stability in SDFC and ICICI too, but the kind of leadership which we were eyeing, at least from the private banking space, that is missing. But on the PSU side, be it Bank of Baroda, Canara Bank, SBI, all are firing. So I feel that until we see some decisiveness in the private banking majors, PSU is something that you should be preferring.
Okay, that's the view on the entire banking universe. But just about 3 minutes to go for the markets to open. Ajit, what would your recommendations be for our viewers this morning?
Yeah, so while we are seeing consolidation, still certain pockets are holding well. In fact, we are seeing fresh breakouts. So HUDCO is one name wherein we have seen fresh breakout almost after like 2 months of consolidation. 257 is what we are eyeing as a target zone. So with stop at 236, one can accumulate HUDCO at current levels. Then we have M&M Financials also. After a strong surge post numbers, there was a marginal retracement, and now after forming a pivot around the short-term averages, it looks set to resume the uptrend again. So 338 is what we are eyeing in M&M Finance. So with stop at 314, one can go long in M&M as well.
Okay, those are the recommendations. HUDCO, M&M. Keep that on your radar. Just want to take stock of what the market is doing in the pre-open session. Hint of green on the Nifty, marginally so 8 points higher. The Sensex down 29 points or thereabouts. Mid-cap index also extremely flat, but trading with a positive bias. Let's see. We're hoping for a mildly higher start, and whether or not we manage to sustain any early gains or not, that will also be crucial to watch. But let's talk about the Adani group of stocks. Rajiv Jain's GQG partner has hiked stake in 5 Adani group firms in a block deal of somewhere around 5,000 crore rupees or thereabouts. Now, stakes have been hiked in the likes of Adani Enterprises, Adani Ports, Adani Green, Adani Energy, as well as Adani Power. Which of these names would excite you? Chartically, I think Adani Enterprises has gained somewhere around 7% or thereabouts in the last 5 sessions. Would you prefer an Adani Enterprises, Adani Power, or Adani Ports? Which are the stocks that are looking exciting on the charts within the Adani group of stocks?
Adani Ports definitely leads the list, because if you see the kind of consolidation that the stock was experiencing for almost 1.5 years, we have finally ended the same last week, and it's still holding above the neckline area of the pattern. So indications are in the favor that it looks comparatively stable, unlike what we usually see the Adani group of stocks wherein volatility remains usually high. Here, the indications are in the favor that we are gradually inching towards the record high zone. So definitely this stock is something that you can look to accumulate. 1445 is the area basically where we have the support, and upside around 1570, 1580 is something that one can maintain as a target zone.
All right, those are the targets and stop losses to watch out. Adani Ports, that's the best poised on the charts within the Adani group of stocks. But let's take stock of how the markets have opened up. First ticks coming in, not a great start, so to say. We slipped below that. In fact, we remain below that 25,900 mark. 40 points cut on the Nifty. As of now, the Sensex down 54, mid-cap index as well, moving in tandem with the benchmarks, down 80 points or so. Breadth, as of now, it's mildly in favor of gainers, but let's see, we'll have to wait for it to settle down to really call it a trend. Bank Nifty, that's also trading with a negative bias, and taking stock of some of the other sectors. And yesterday, all of the sectors ended the day in the red, and metals and real estate, they were the top 2 losing pockets yesterday. Today, IT is the sole sectoral gainer, up 0.2%. IT, managing to buck the trend. But otherwise, real estate is the top laggard, extending its losses from yesterday. That's index was down 2% yesterday. Autos closed second, down 0.3%. Metals also extending losses. FMCG, pharma, all of these pockets are losing in trade. Let's see which are the stocks that are managing to buck the trend. As I mentioned, Infosys buyback opens on the 20th, which is, I think, it opens on the 20th, yes, and that's why the stock is in focus. It's up 1%. Even HUL, date for the demerger is out, and early December. So that stock is the top Nifty gainer as we speak. Other names, other tech names are doing well. The likes of TCS, Tech Mahindra, Wipro, HCL Tech, all of them are trading in the green. Aside of HUL, even Nestle from the FMCG pack is doing well, and so is Tata Consumer. Trent also, by the way, holding out in the green. Side of that, you have Shriram Finance that's doing well. You have Power Grid that's doing well. Adani Enterprises, we already discussed the Adani group of stocks, Adani Enterprises in the green. On the flip side, Tata Motors passenger vehicles are down 1%. Recently, the stock got hammered after its numbers widening JLR losses, and today it is resuming its downtrend. Bharat Electronics among the top laggards, so is Eternal, which has been witnessing a lot of profit taking. That's also down. Apollo Hospitals trading in the red. Even some banking names and financial names like HDFC Bank, Geo Financial, Bajaj Finserv, these are all trading in the red. Interglobe Aviation, that stock is also down somewhere around 0.3%. But let's talk about HUL then. Since it's managing to hold out in a weak market, the board has fixed the record date for the spin-off of its ice cream business, Quality Walls. Of course, that's the 5th of December. This means that the record date will determine which shareholders of HUL will be eligible to receive shares of the new entity, and the demerger scheme will be effective 1st of December. Staples haven't really fired up, Ajit. What are your thoughts? I think Tata Consumer is the one that has outperformed other staple names. So how do you look at shares of HUL, Tata Consumer at the current juncture?
So that's right, and that means except Tata Consumers, we saw that majority of the names after the initial positivity which we saw post the subsidy cut announcement witnessed attraction, but they couldn't sustain the gains, and that holds true for HUL also. Means again we are back to the square. Broadly, it's been almost like 4 years now that we have not seen any major returns, and on the short term basis also, we are still struggling around the major averages. So it seems like that the consolidation tone or the sideways bias is here to stay for a longer period until we decisively see some sign of decisive traction and some accumulation as well. So as of now, it seems like that 2500, 2550 on the upper side will continue to be the area where it might face resistance. On the downside around 2400, 2350. So this 200 point is something that might continue to hover in. In case if you are stuck, use any recovery to reduce your position. If you are planning any fresh trades, strictly avoid.
Okay, that's a call on HUL. But Marico, what about Marico? Because a lot of technical analysts have flagged off Marico among their top picks, and the stock did hit a fresh 52-week high earlier in the week. Would you also be a buyer of Marico at current levels?
So yes, Marico and Britannia, alongside with Tata Consumers, among the FMCG basket, wherein we saw relatively higher strength, throughout this consolidation or declining phase in the market and the FMCG space as well. So after this new record high, there could be some consolidation. So it's not that one should jump into a trade. Yes, in case if there is any dip around, let's say 740-45 mark, there you can start accumulating the stock with 730 as a stop loss. And gradually we can see the stock inching towards 780, 800 mark.
Okay, that's the view on Marico, 780, 800, those are the levels that one can expect on the charts. But let's talk about the second big gainer on the index, that's Infosys. The buyback date has been announced. The buyback will continue till the 26th of November. The stock is trading just sub 1500 levels at the current juncture. Last 5 days hasn't given positive returns, but IT, we do see those days when IT takes the lead, but then it doesn't really manage to sustain. Would you say that the risk reward for stocks like Infosys, TCS is looking good after the kind of underperformance they have seen in comparison to the rest of the market, the IT pack?
Yes, Nandita. So let's say if the view is medium to long term, definitely they offer better risk to reward ratio. But in the short term, the lackluster move, like you rightly mentioned, that one day we see, in fact, there were a couple of occasions where they were leading from the front, but they couldn't sustain the gains. Means for the Nifty IT index itself, we are still trading below the long-term averages. So the moment, let's say, we surpass this 37,000 mark in the Nifty IT index, then probably it would set the stage for the next leg of the up move or recovery in the Nifty index for roughly around 2,000 points. And then majority of the large cap names, including Infosys, can surprise the market positively. But as of now, TCS looks comparatively better structurally. When it comes to the fresh long positions or accumulation. Infosys, it might continue to trade in the range until we see some sign of decisiveness above 1550 mark. So as of now, IT as a pack, consolidation is likely to continue. But yes, if somebody is looking to accumulate for medium to long term, they can definitely consider.
Okay, you can look at accumulating the likes of TCS and Infosys for the long term. But let's talk about a mid-cap buzzer, Deepak Fertilizer. The stock is among the top gainers on the Nifty 500 index, and there is a catalyst because MK Global has initiated a buy call on the stock, the target price of 2,000 rupees. Now, they've mentioned that the company is a leader in the mining and industrial chemicals with a dominant share in domestic markets, and it's also a market leader in water-soluble fertilizers. They've also mentioned that the product portfolio is well aligned with India's growth story, and of course, the company is planning to transition from commodity to specialty offerings across its existing product lines. How would you look at the likes of a Deepak Fertilizer? Because all these fertilizer names, they see some pops here and there, but then the follow through buying never really comes by. For a stock like Deepak Fertilizer, would you look at it as a trading play now? And what are the next levels to watch?
So yes, Nanda, means it's very difficult to time such stocks wherein we see a cyclical move which could last for a month or two, and then usually the moves fizzle out. But surprisingly for Deepak Fertilizer, it's comparatively stronger. Means after making a new record high, there is a marginal retracement towards the long-term averages, which is roughly around like 3, 4, 5% away from the current area. So that clearly shows that in case if the entire sector is on the back foot and you are still maintaining to hold around the record high zone, that clearly shows strength. So the moment we will see some bit of buying interest, because the pre-budget discussion have already started. So and in case if there be any positive things for the agri pack, you will see that Deepak Fertilizer can positively surprise the market, and probably 1600, 1650 is something that the stock might test. So as of now, 1370 is what we are eyeing as a strong support area, and that should be the stop loss if you have any existing position or you are planning any fresh trade.
Okay, that's the view on a Deepak Fertilizer. But on that note, let's shift focus to all the viewer queries that are trickling in. I know that for recent listings, you guys don't have a lot of data to really call a trend. But I'm really tempted to ask you about your thoughts on how Grow has been rallying, and the stock price is quoting at 90% above its IPO price. It has hit major milestones in terms of market capitalization as well. We keep getting queries from our viewers as to what they should do because they're holding their shares. This Naveen has sent a query. He holds 1,000 shares at the rate of 103. He wants to know whether he should book profit or not. I mean, although I'm sure you don't have a lot of data, but any thoughts on how people should navigate their positions? Should they hold on to it, or should they book profits partially at least?
So my question to Naveen is, Naveen, what kind of returns that you were anticipating before you took the position? Means 103 and now 183. So it's a phenomenal return. Means in case if you hit the jackpot, and especially when we know that it's riding for some other reasons also, because we have recently read that few shorts are also trapped. Not few, but it's a good quantity. So that is triggering this kind of a phenomenal surge in the stock post listing. So as of now, at least 70-80% is something that you should definitely book if the view is short term and you've already got the returns. If you are an investor and you have a time horizon of 2-3 years, definitely you can stay put. There's no harm in that.
Okay, that's the view. It depends on what your expectations are at the end of the day. But yes, that's what Ajit's advice is. It makes sense to book some profits. But let's shift to the next query then. This one's coming in from Preeti Singh. She wants to know your thoughts on a fresh entry in Reliance Industries. She recently exited Reliance after making a 15% profit, which is a decent profit. Now at 15, 17 or thereabouts, is it a good time to enter or should one wait?
So first of all, congratulations because you have made decent returns. 15% is not a usual return in Reliance, kind of a heavyweight, and you have exited at a very right price, Preeti, because this is the area basically last time where Reliance, witnessed a sharp, profit taking and correction after that. So there is signs that we are seeing time-wise correction while the markets are sitting on the sidelines. Reliance is comparatively holding strong, which is definitely a good sign. Should you look for fresh long positions? My approach would be to accumulate, not to go at one go. So let's say you buy at current levels. In case if there'll be any decline around 1480-85 zone, you may add more. For the entire position, 1460 should be your stop loss, and above 1450, 1540, sorry. We are set for the new record highs. So accumulate in the range of 1515 to 1485 with stop at 1460.
All right, that's the view. Accumulate, don't go all in at one point in time. But let's move on to the next query then. This one's coming in from Dheeraj Sharma, and he wants to know your thoughts on IEX. He's holding some shares, 30 shares at the rate of 188, making a fair bit of loss here. Wants to know whether he should hold, sell or average. Of course, he's looking to reduce his loss. The stock of IEX has tumbled over 35%, since mid-July. What would you advise? Would you advise him to average or, reduce positions at every bounce, or what should the strategy really be to at least pare down some losses?
Right. So Nandita, after this, sharp cuts, post that news of its monopoly in under danger, and since then we are seeing that stock has been struggling. Means there were multiple attempts for recovery. Around 150 is the mark basically where it it tested twice, but it couldn't sustain. So that clearly shows that the strength is missing, and 130 on the downside is what is currently playing out as a key support area. So we are very close to that mark. So probably we may again see an attempt of a rebound. But the trend looks, negative overall to us. So I definitely recommend him to reduce his position on rise. Let's say any rebound towards 145.50 zone, you should look to liquidate. Or in case if it breaks 130 prior to that, then also you should liquidate, because in that case there could be a next leg of fresh selling, which could push the stock towards 100 or maybe lower.
Okay, that's the view on IEX. Hope that answers your query. There's a query on Akzo Nobel. I want to take it up. This one's coming in from Aisha. Wants to know whether it's ideal for a short-term entry now. But within the paint basket, it's the leader, Asian Paints, that's really making headlines after good set of numbers. Stock is also, seen an upward trajectory. So would you look at Asian Paints, or would you advise, a short-term play on Akzo Nobel as well?
So Akzo Nobel, I would definitely avoid, because the kind of price action of volumes, this is not very encouraging for short-term trades. Definitely Berger, Asian Paints, they are better candidates to look at if the view is short-term. But after this recent surge, I feel that one should not jump into a trade, let them consolidate, because the move was very swift, roughly around 11% kind of a gains that we had in Asian Paint last week. So let them consolidate a bit, and keep a close eye on crude oil as well. Means we usually see that the movement of crude usually influence their stock prices a lot. So as of now, yes, Berger Paint and Asian Paint is something that you can look to accumulate on dips, but not at the current levels, and avoid Akzo.
Okay, avoid Akzo, but you can look at Asian or even Berger Paints. But couple of more queries then. Let's talk about Sona BLW as well. I spotted a query from Alex. Wants to know whether a fresh entry for the long term is advisable. What would you advise? The stock has done okay in the last month or so. It has gained somewhere around 8% or so. But of course, it's come off quite a bit from its 52-week high of 700. So do you see the room to rally here on, and should one really position themselves in the stock?
So yes, Nanda, recent price action indicates a possible reversal. Means not a short-term reversal, but in fact a long-term reversal. Need slightly confirmation from the volume also, but overall it looks positive to us. Means yes, you can start nibbling in Sona with medium to long-term perspective. Now 460 is what we are eyeing as a strong base, means 10% away from the current area. So if you're okay with that as a stop, you can definitely start nibbling. 540, 560, that will be the next key decisive zone. And then probably we'll have a confirmation that we are set for decisive uptrend in the medium to long term. So selective buying can be done at current levels as well.
Okay, selective buying can be done at current levels. Hope that answers your query. Let's talk about one more query, then two more queries to go actually. One on the flexible workspace. Yesterday, WeWork India saw good traction. Of course, there was a positive note coming in from Jeffries. Office space. There's a query on this stock from Satya CK. He wants to know whether he should average for the long term. The stock has been stuck in a downtrend. What is your advice on an office space, and looking at whatever data you have for WeWork India as well, how is that stock looking?
Samantha, most of these stocks are recent listings, so we don't have much data to comment upon. But basis the available information, it seems like that they are trying to form base. So usually, when it comes to the new IPOs, one should wait for them to surpass the listing high at least for any confirmation that yes, they are establishing a trend and they are set for at least some directional move. So as of now, that's not the case for WeWork. Roughly around 660, 670 is a zone basically where it made a record highs post this listing. So the moment we surpass that zone, then probably we can see a next leg of the up move. But since your view is long term, refrain from any aggressive positioning as of now. Wait for at least 2 quarters of numbers and see how the companies are performing, what kind of guidance the management is offering. Then you should look to invest or add to this position.
Okay, point taken. Very quickly, last query coming in on a Fortis. Person wants to know, whether he should exit or average or remain invested. He has 550 shares at the rate of 1057. What would you advise here on a Fortis, Ajit?
So Nandita, we all know the kind of momentum the stock experienced from roughly around 250 to 1100. There was hardly any decisive correction. It was more of time-wise correction that we had. Now at least we are seeing some sign of stability, reversal. You can say short-term reversal, which could further push the stock lower, let's say towards 870, 880 area. So if the view is long-term, you can definitely look to accumulate around that area, not before that. If your view is short term and you are stuck, use any recovery towards 970, 980 area to reduce your position. And in the interim, your stop should be at 910.
Okay, that's the view on a Fortis. But with that, we are completely timed out. Ajit, would like to thank you for taking out time and joining in and sharing your thoughts, also helping our viewers with their stock-related queries. I look forward to our next interaction as well. Have a good rest of the week, and I'll see you soon.
Thank you, Nandita, and same to you. Take care. Bye.
Thanks a lot. Well, on that note, markets on the back foot. Midweek wobble, you can call it that. 25 points down on the Nifty, and the Sensex down 50 points also. The advanced decline ratio now favors declines. On that note, let me bring on board our next guest. Joining me is Yogesh Patil, Equity CIO at LIC Mutual Fund. Yogesh, welcome to the show. Great chatting with you. This is our first interaction. I want to get a sense from you as to where we are headed in terms of the market. 2025 hasn't been very different. Now that earnings season is out of the way, we've had the Bihar poll outcome as well. Is my voice reaching you, Yogesh?
No, actually, there was some break in voice. Can you repeat the sentence again, last sentence?
Sure. I'm saying that 2025 hasn't really been a blockbuster year.
Yes.
for the Indian market. Now we've had most of the cues that have played out. Second quarter earnings are out of the way. We've had the Bihar poll results, that has put to rest any concerns over political uncertainty. Now India-US deal also in sight. What do you think? Where do you think the markets are headed? Do you think 2026 could be the year of double-digit returns as everything falls into place?
Yeah. Good morning, everyone, and thank you for hosting me on your channel. See, most of the negatives already factored in last 1 year. If you see the in India long-term structural trend is very positive, and India story is not a basically 1 or 2 year story. Is a basically multi-year story. Is completely driven by introduction of new sectors and a very high growth in existing sectors. And some sectors it's followed by new trends like urbanization, increasing per capita income. Again, it is followed by discretionary spending and your improvement in CAD. So most of the all these major parts which require for bull run is already there. And you are absolutely right. Bihar election and we are very close to US trade deal, and inflation is again in favorable zone. RBI and government started actually acknowledging where they need to do reforms. So macros are stable. Policy liquidity is in much better shape. Corporate earning is yet to improve from here. Actually, the majority of the corporate shown some improvement in their commentary, and obviously in Q3 and Q4 we may see better earning growth, and that will reflect in market. Actually, currently it might possible due to sluggish earning or maybe global uncertainty. Market is not actually paying attention on all positive factors. And as everyone knows, market is basically driven by your valuation, liquidity, and earning growth. So once the everyone investors or maybe FIs see the earning growth, definitely India is not India is a country, only country in the world where you see the longevity of the growth and the quality of the growth is very high, because again is followed by policy reform, macro stability, better inflation, and well managed actually monetary policies. So considering everything, I'm sure I'm very positive, and things can only improve from here. Maybe we can debate on time.
From a long term, Sure. From a long-term perspective, India is a structural story. People have been pointing that out. But my question is, over the next 5 to 6 months, how do you see the trajectory panning out? Given the fact that, we've seen a lot of these positives play out. But do you think there's a lot more room to grow, to go up from here in the next 5 to 6 months at least? Since the next 2 quarters, as you pointed out, will be much better than what...
See, can't comment on market because again, market is driven by so many factors like global events. There are a lot of political events. There are a lot of basically monetary policy changes has to be readjusted and corrected globally also. So if you ask me, the one lever from India side is very clear, and if globally situation will improve, definitely it should reflect in market movements. That the only thing I can actually acknowledge. Because India is in much better shape compared.
Sure.
So globally, I'm seeing
India is in better shape
comparatively last 20 years. But interest rates is a questionable in let's again Japan, US, everywhere. So monetary policies and trade policies actually drive the future direction for the market.
Okay, so of course, since you are talking about monetary policy, what are your expectations from Fed in December? Do you think chances of a rate cut are pretty slim there? And secondly, back home, we've had record low inflation data, although the RBI did front load rate cuts. What is the rate trajectory here on for the rest of the fiscal? Would you expect another 25 basis points, or would you stick your neck out and say that 50 basis is also possible given the kind of inflation data that we had last month?
Can't comment on quantum. But considering inflation, definitely there has to be some liquidity improvement, and rate cuts is possible. I'm not denying that part. But 50 can't comment. And coming to the Fed rate, see in US there are a lot of things are happening politically also, and monetary policy is again still struggling. So considering fiscal deficit and inflation and tariffs is a very challenging environment for Fed governor. and at same time it's very difficult to guess what he need to factor, because unless the we get a more clarity on tariffs and inflation, so I don't think there will be any cut from US.
Okay, rate cut ruled out in the US in December at least. How are you assessing the second quarter earnings season? Some pockets did well, better than expectations at least, if not well. But there were some that were, disappointing as well. So what were the big hits according to you, and what were the major misses in the quarter gone by?
See, this quarterly is very, very different because we've seen in GST reforms and we've seen extended monsoon. For some of the sectors like engineering, capital good, majority of the companies shows a phenomenal results, followed by private banks and even FMCG and auto companies. Their commentary is really good, and we need to again recheck or reobserve in Q3 results. And most of the other companies are actually struggling between the extended monsoon and GST cut and basically low activities because of elections and lower spending by states government. So S2, why we think S2 would be better than H1? Because the seasonality factor is favorable. We have a GST cut already on the plate. Second, government spending has to improve from here. And same time, we are very close to US trade deal, and both governments also supporting each other argument to close it. And these are the major factor. And once you get a more clarity, definitely export-driven companies started actually showing good numbers. Maybe for this quarter, there would be subdued from export, especially on US side. But overall, if you ask me, the Q3 would be better than Q2, and Q2 results were mixed with a higher optimism and expectations in H2. So net is a neutral to positive.
Okay, got your point. But if you talk about sectors, specific sectors that have done well, they, most of the cyclicals have done well in the sector in the quarter gone by. The likes of metals, metals, OMCs, etc., have done well, and so have banks, particularly PSU banks. Autos, on the other hand, numbers have been good. A lot of good news. A lot would argue that it has already been priced in. Where do you think the next, leadership will emerge in the next leg of the up move?
There is a strong demand coming from actually power and power transition from electric green, from thermal to renewable, and that led to a bigger capex in T&D space, and it is a and that's I already highlighted, it is a multi-year story. And data centers, increase in domestic manufacturing from defense and EMS space. So these are the major driver where we see a strong visibility. And where potential, if you ask me potential wise, certain sector like aerospace, specialty chemical, and CDMO actually showing a very promising growth in coming years, because we need to see some ground level visibility on these sectors.
What about consumption? Of course, you mentioned consumption. It has been a mixed bag, so to say, because staples haven't really been able to take off. So what do you like in the consumption basket? Would you prefer discretionary rather than staples?
Sure, because India is a growing company, and as and when per capita income grows, the spending on discretionary consumption goes up, and the basics essential as a percentage of income is always coming down, and that is reflected in last 3-4 years. But if you see the discretionary consumption and basic consumption is a big difference in growth. Discretionary consumption grew almost 30 to 14% in last 10 years, versus basic consumption hardly grew around 9 to 10% in last 10 years. So is not a shift or switch, is basically is the effect of increasing per capita income, and incremental income has to spend on premiumization and maybe discretionary whatever consumer wants actually. So it is a combination of premiumization, combination of what are the additional choices, urbanization, life upgradation. So it is a new driving trend for India, and the middle class is growing at very good pace. And for next 10 to 20 years, we do see this trend will continue and getting higher and higher. So ignoring discretionary consumption is very difficult, because consumer choices increase. People are ready to pay for any prices for their choices. So now the new business model for companies, like they need to fulfill the demand by introducing new product, better services like that. So this is a very attractive and high growth space. Maybe mass consumption valuations are attractive. We may see some growth here, but not a very structural or maybe outperforming growth compared to discretionary. That's for sure.
Okay, and within the consumption basket, what are your thoughts on the new age consumption stocks? Do you like any of these food delivery plays, quick commerce plays, beauty tech as well, the likes of Nykaa? Have you looked at this at LICMF?
I can't disclose the name, but I'm saying there is a new trends, and consumers are
Of course.
shifting to new platforms, and these are the basically figure out the opportunities very quickly. Obviously, online is very there is no history, but considering what they are doing, and there is a gap in and consumer likes that gap means ki either you improve the convenience or may increase the service or offering a better product. And as I already highlighted in discretionary consumption, consumers ready to spend any amount for their comfort and the new products. So all these platforms are actually completely aligned to the new kind of consumers, but where paying capacity is very high. So definitely, all platforms cannot be successful because these are this business model built on certain thought process. Sometimes this thought process doesn't work, but in some and some are actually really doing well. So we can't ignore those businesses at this point of time.
What about the recent listings and IPOs that have hit the market? A lot has been spoken about and debated over valuations, but if you look at the valuation metrics itself, instead of PE, PB, price to earnings, price to book, these metrics have become passé now, because people are now looking at price to sales, price to earnings growth ratio. So my question is, how does one really value some of these new companies that are hitting the street?
Sure. See, new age companies are growing at very high pace, and as I already highlighted, the growth is very high, and now there is a structural shift in the mindset of the promoters. Majority of the capex, I think, in traditional companies are done or maybe capitalized in your gross block. The now new age companies, majority of the capex is passing through your P&L. So there is a big difference. And once you get the operating leverage is very, very high. Just I can't name the company. If you see the last 2-3 years, some of the new listed companies on online platform, because they are working on contribution margin and operating leverage. So it is very difficult to quantify valuation or justify at initial stage. But if you take for next 5 years, definitely case is very attractive in some cases because it's a more of a disruption and creating a new market, new consumers. So we need to value them on based on PEG ratio, where the PEG is the ideal way, or maybe discounted cash flow of the future years, where where investor think at initial stage is very difficult to value. But I think these two metrics are actually really helpful when you analyze this kind of companies, because after 2-3 years or maybe some years, you see a big beneficiary of operating leverage, and at this point of at this point of time, it's very difficult to quantify this operating leverage and increase in profitability.
Sure, point taken. PEG ratio and perhaps discounted cash flows, that could be a good way to value some of these new companies that are coming to the street. But let's veer away to the traditional power sector. This has delivered a mixed performance in the second quarter, with merchant power companies bearing the brunt of an unusually heavy monsoon. Sharply reduced peak electricity demand, that was disrupted by the seasonal, the usual seasonal uplift that it usually sees. Should one veer away from traditional power plays and look at the renewables, renewable plays instead of the traditional power names? What are your thoughts on that? How should one really look at the power sector? The new renewables look more attractive now, given the prospects.
Okay. See, we need to, as an investor, we need to see where there is opportunities coming, right? Let's take in renewable. There are three major portions here. One is asset creator, like EPC and capital company. Second is asset owners, where they do continue utility business. And third is beneficiary of the asset owners, right? Sorry, beneficiary of these assets. So in initial phase, asset creator would benefit most, but in case of renewable power, that spend is much higher than thermal power, because there is almost 2.5 to 3x spend on transmission and distribution because of the renewable in nature. So initially the capex would be very high, and these companies will be benefit most. And we investor does have an option of playing the export market as well. So there is opportunity in power sector. So as an investor, we should look at where the ROC are better and where the risk reward is favorable. In some cases, obviously, I'm not denying utility companies or not investable, but it is all dependent on what you think and how the investor profile suit this. So coming to the point, the real money making opportunity or big opportunity is only available at this point in capital company, where we see the asset creator model. And because you can move to next cycle, and you can move to next market as well. There is a growth coming from thermal and green renewable also, is because of your urbanization or because of the new data center increasing manufacturing. And if India want to be a manufacturing leader, we need to provide a sufficient infrastructure to growth and increase the manufacturing as a percentage of GDP. So these are the long-term thought process of government, and I think there might be a seasonality in some quarters because of the extended monsoon or change in the environment. And we also know your cooling demand has reduced once you have a favorable weather. So it get reflect in maybe Q4 kind of power demand. But India need to see for how the next 20 years has to grow. And there is always be some basically promotion of green energy and obligation to state government. And I'm sure, once the state government started implementing, these are the sector again can grow much faster. So investor has to evaluate where he want to make money, because in utility business definitely there is a you get a fixed income, but there is a limit to fixed income every year. So it is get valued at nearly bond value or maybe kind of utility valuations. So as a house, we believe in asset creator model rather than asset owner model.
Okay, got your point. Last couple of questions then. I think you also mentioned EMS. Of course, that's touted mostly as a sunrise sector. But despite the recent correction, many stocks are still multi-baggers, and they have been multi-baggers over the longer term. Questions on valuation really. Do you think they are finally looking reasonable, or do you think the sector still needs to deliver more on execution?
Sure, definitely every sector has to deliver to justify the valuation. So only difference here is how much growth you're predicting, and because it's a structural, because Indian electronic consumer market plus obviously industrial market is somewhere around 4 lakh crore, and there is a hardly value addition is happening in India, even in mobiles, consumer electronics, and defense, railways, everywhere. So there would be volatility in earnings, and because of the volatility in earnings, you may see a bloated valuations, right? But if you see the consistency and you get a size, definitely these are the discovered companies and discovered sector. So from here, the chances of re-rating would be very limited, and stock appreciation might be equal to the earning growth from here. So and most of the companies shown a really good order book and visibility, and we may expect further improvement in guidance after once the trade deal, they get a clarity on trade deal also. And from domestic manufacturing, government also supporting these domestic companies, and if it's also depend on the government environment ecosystem provided by government. But we do see a strong growth. But coming to the again initial point, these are the discovered stories where re-rating. These are the not re-rating candidates. We need to participate the growth in these stocks.
Okay, one must participate in the growth when it comes to the EMS sector. But let's talk about the US-India trade deal. we are very close to that now, as per the reports and commentary coming in from the US President and his team as well, and some statements made by the Commerce Ministry here as well. But some export related themes like textile, chemicals, they fell out of favor once those tariff announcements were made. Is it a time, or is it a good time to relook at these sectors at these levels?
Valuations I can't comment, but even if you take a trade deal or no trade deal, some of the export companies are really doing well without trade deals, right? You see the quarterly numbers. Because some of the products US can't produce, that's for sure. There might be delay in purchasing. But if trade deal happens, definitely there is a strong case for these companies. And China plus one story, which we actually started ignoring. But I think there is a strong opportunity on both sides from US exports and non-US exports. Because once we have a sufficient manufacturing and infrastructure base, and I think India is heading for a good export growth in coming years, and that's the overall government target. Government targeting obviously higher export, and they're shown in EMS sector earlier. I think 10 years back we were net importers. Now we are net exporters, right? 10 years back, semiconductor production was actually a mere dream. But today there are companies which setting up a plant for semiconductor, and it's a slowly picking up. So deal will definitely accelerate the growth, but without deal also India can still grow. There might be a setbacks in certain sectors where margins are low, and these products are not replaceable. But I think once the trade deal happen, all the sectors, including the higher valuation or maybe lower valuation, every company and sector need to be again reassessment based on the tariffs, terms and condition. It's very difficult to analyze at this point of time, but we need to see the terms and condition of the trade also. What we are getting and what we are exporting, and what are the terms and conditions.
But what are your expectations in terms of tariffs? Do you think it will settle around 15-18%? Of course, India has reduced, Russia oil purchase. That was one of the key conditions. So, what are your expectations? Of course, I'm sure you can't really comment on what will happen, but any expectations that you're working with? Right.
I don't know the number, but
okay, last question really.
17 to 20% might be.
Okay.
Yeah, I think 17 to 20% would be reasonable.
17 to 20. Okay, 17 to 20% could be reasonable. Okay, lastly, any sectors that you've rotated out of in the last 2 quarters that you feel is an avoid right now, perhaps could be relooked at later in the later on sometime?
Yeah, some of the textile players and export-driven companies where there was no clarity, we not exited, we reduced the positions.
Okay, but post the trade deal, would you look at them again?
Yeah, sure, why not? Because once the environment changes, your business outlook also changes. Because see, without this trade deal, it's very difficult to project the profitability for 5 years.
True that. All right, Yogesh, lovely chatting with you. We look forward to more conversations. Thanks a lot for taking out time. Appreciate it.
Thank you very much.
Thanks a lot. And on that note, take a look at the markets. We are back into the green. In fact, we've paired all those opening losses. The Nifty is back above that 25,920 mark. The mid-cap index is also edged back into the green, but the breadth remains negative. 2:3, that's the NSE advanced decline ratio. Bank Nifty as well trading in the red. But let's see some of the stocks that have participated in this turnaround from early losses. Infosys has only built on those initial gains. It's up almost 2.5% now as we speak. HCL Tech, TCS, Tech Mahindra, Wipro, all these names are on the gainers list on the Nifty. So it's the tech pack that's taking the lead. Let's see what the gains are looking like on the Nifty IT index. Almost 2%. Okay, that's a 2% gain on the Nifty IT index, and that has led the Nifty to pair some of those opening losses and edge back into the green. Auto sector or auto index has also edged back into the green. That's trading with gains of almost 0.5%. Real estate continues to be on the back foot, and so does pharma. both the banking indices, PSU Bank and Nifty Bank Index, both of them are trading in the red, some bit of profit taking there, and metals as well, trading with a lag. But it's the IT pack that's staging this or scripting this turnaround that we have seen in the market from the opening lows. On the other hand, although the auto index is up, Tata Motors passenger vehicles continues to be in reverse gear. That's the top Nifty laggard. But let's see, early to say whether or not we could end in the green today. We'll of course take stock of that on the closing show, which starts at 3 p.m. So don't forget to tune in for that. We'll get you a whole host of experts. We'll talk about all the stocks that would make an impact in today's trading session. And of course, we'll see you at 3 p.m. then on closing bell. Thanks a lot for tuning in. Stay tuned to Money Control for all your other news and updates. I'll see you soon.